Purple Tree Crew, connecting people, building communities, helping clients to build multi-generational wealth through real estate.
Right now, let's focus on rental properties under literally personal names. What are the differences if it's rented 100% or 50% or more? Can you tell us more about that?
Okay, so looking at a principal residence and you're renting a portion of your house, you must rent, or the portion we put on your tax return has to be under 50%. But unfortunately, then you can only write off up to 50% of the costs. However, it really has to be based on square footage. So if you rent the basement and live on the top 2 floors, then, a third of the house is deemed to be a rental property. And so you can write off a third of all the expenses of operating your property. And we can talk about insurance and property tax, utilities, including internet. The biggest one is interest on the mortgage. I want to be clear, it's interest on the mortgage, not the full mortgage. Not the full mortgage payment. If you have condo fees as well, then, and you rent out, it could be a townhouse or whatever, you can rent part of it, and so you can write off that proportion of the house. One of the areas when it comes to your principal residence and you're renting a portion of it out is maintenance. People like to say, I can write off this and that. CRA does not like you writing off outdoor work, i.e. landscaping or snow plowing, for example. Those services, CRA would figure that you already have them, whether you rent or not. So they don't allow outside maintenance work when it's your principal residence. The other thing is...
Norman, sorry. What about if, for example, you need to repair or redo the driveway or roof? Would that be considered as a cost that you can write off?
Good try. Part of it. Driveway, since it's outside, no. Roof, maybe. Roof, there's two types of roofs, believe it or not. One is replacing a roof with what you've already got, i.e. asphalt shingles, you replace with asphalt shingles. That would be considered an operating expense, and yes, it can be written off against the rental income. However, if you replace your asphalt shingles with a metal roof, then that actually increases the value of the house, and so it cannot be used as an operating expense, cannot be written off against other incomes. And it sort of goes into, if you paint the whole house, say, then you could use just the ratio of what you use for rentals. However, if you just paint the apartment or do repairs to the apartment or the rental area, then those can be 100% written off as well. Mm-hmm. Just as long as when you replace something, it's with what was originally there. Then, other than that, because anything else is increasing the value of the property, and CRA does not like you to write off.
Use as a maintenance.
That kind of, the things, like if you take a bathtub and put in a jacuzzi tub or something like that, that's better than what was already there. But those are fine little details, and we can always talk about things like that too. So.
Okay, great. So anything that would add value is not going to be considered as an expense. If you are going to take it as a consideration for maintaining the property, then it needs to make sense of what kind of, whether it's adding value, like the roof, a lifelong roof that you want to put in, or shingle that would definitely be used as a maintenance, not having any leak or any issues for the tenant. So, Norman, what are the differences when a property is 100% rental or short-term rental or part-time with respect to tax implication?
So it changes when it's a 100% rental, because then there's no principal residence component, and property will be subject to capital gains tax when it does get sold. So it's the same deductions, but this time it's 100% for if there's utilities, property taxes, insurance, and maintenance. And that would include outdoor maintenance this time because it's 100% rental and you've got to maintain the property. If you do put a metal roof on, that is increasing the value of the property, so that still is not tax deductible. However, it gets added to the value or the cost of the property. So it will help reduce the capital gain impact when the property is sold. And usually I always include some office expense and some bank charges. People don't think of those little things, but every $100 of expenses might reduce your tax bill by $30. So why not? Advertising, I've mentioned either, in both cases, is 100% deductible no matter what, because you're advertising exclusively for tenants. So whether it's principal residence rental or a 100% rental, it's still tax deductible.
Okay, excellent. So that clarifies a lot of things. Tell me, Norman, we hear a lot of Canadian residents, just COVID, we see more often actually, who are relocating to different countries or working most part of the year somewhere else, for example, in US, but they still have their principal residence in here in Canada. They come and go, and they have, let's say, certain consideration. Either keep it that way, with using the property for every time they come back because they're principal residents somehow at this point, or rent it out. If the property has been lived in as principal residence for over a decade, and suddenly for a year or two they decide to rent, what would be the tax implication? Or if they simply are relocated to another country and they use their home only when they come back visit the family in Canada, what would be the tax implication in both cases?
So there's a lot of areas you brought up in this one. And the key to not living in Canada, but having a property in Canada is, what is your residence determination? So if you're deemed to be still a resident of Canada, then there's no other impacts other than the fact that if you rent it and it's 100% rental, there could be what CRA calls a deemed disposition, and you would be subject to paying capital gains tax on its value when it changed from your principal residence to being a rental property. And vice versa, when you came back to Canada, there's another deemed disposition. So it gets a little complicated. The bigger issue is if you're deemed to be a non-resident, or if you are a non-resident of Canada and own a rental property in Canada, there's a lot of extra challenges with that one. And that the last time I checked, the rules are you are to have an agent that collects the rental income and sends 20% of it monthly to the government. And the government's just waiting for you to file a non-resident tax return, and because it wants to protect, the income that's being earned in Canada, protect Canadian, all the other Canadian taxpayers. So there's a lot of really specific rules around if you are a non-resident of Canada, own a property in Canada, and it gets a little more complicated. Now it really gets complicated if you sell the property, because there's a special form that has to be filed within 10 days of the sale. You've got to submit I can't remember, like 20% of the sales of the increase in value to the government, and huge things have to be done right away. And so it's a big area and it has to be jumped on right away. There's no, I'll deal with it next week or next month. You've got like 10 or 15 days to get this form submitted, and the penalties are, not nice.
So it's really, thank you, Norman.
Purple Tree Crew, connecting people, building communities, helping clients to build multi-generational wealth through real estate.